Hi, students. Welcome to another class. Today, I will be discussing value-added tax. Yes, VAT. We all know VAT. Value-added tax is a tax which is levied on the consumption of goods and services. Yes, VAT, value-added tax, is a tax that is levied on the consumption of goods and services. So today's presentation is on value-added tax for UNISA students, those who are doing tax 3701 and those who are doing tax 3761, as well as postgraduate students who are doing 4861. As well as other students from other universities. You will find this presentation very useful. So let's look at what we are required to do on this question. The question would like us to determine value-added tax payable or refundable on each of the transactions that were entered into by our taxpayer Glamour Private Limited for the 2 months of tax period ended on 20th February 2026. Before we start, let's look and learn more about the taxpayer. Who is the taxpayer? The type of business the taxpayer is involved in. Yes, Glamour Private Limited rents out customs and evening wear. The company is a registered vendor for value-added tax purposes and is registered on the invoice basis, which is very important, on the invoice basis. Jan Nathaniel is one of the company's shareholders and a director. The following information relates to some of the transactions that occurred during the period January and February 2026. All amounts include VAT where applicable, unless otherwise stated, or if the law implies so. So I'm going to look at each and every transaction separately. So it's a matter of us being required to determine value-added tax, which is payable on each of the transaction from transaction 1 to transaction 3. Yes, let's see. If you are to determine value-added tax or payable, an accountant or a tax practitioner should have a sharp eye. You must be quick. As we read, you must be able to pick the VAT implications of each and every transaction on this transaction. So during January 2026, some of the evening wear, a fax machine and a computer were stolen from the business during a burglary. In February 2026, an insurance company paid an amount of 128,000 to the company as a partial compensation for the evening wear. A fax machine to the value of 6,000 Rand was also replaced by the insurance company. The total insurance premium paid for all the company's assets for the period January and February 2026 is 1,100 Rand. Since the above insurance claim took a long time to be finalized, Mr. Litaniel decided to sell his personal computer to the company on 25 February 2026 for use in the business. The selling price was 8,000 Rand and the market value is at 25 February 2026. Mr. Letaniel originally purchased the computer for 10,500 Rand. He used the computer 80% for business purposes as from 25 February 2026. the company also purchased an antique mirror for business use from Litaniel Smather for 5,000 Rand. Let's determine a VAT payable by or refundable to Glamour, who is our taxpayer. So VAT payable or refundable, when you calculate, it's a matter of saying output tax. You have to determine all the transactions with output tax, and then determine all the transactions with input tax. Then you are going to say output tax minus input tax. If output tax is more than input tax, then it's VAT payable. As the taxpayer would be owing SARS some money they have to pay. But if it is the other way around, where input tax is more than output tax, then the taxpayer would be refunded. So on this transaction, it's a matter of you identifying which transactions have got output implications and which transactions have got input tax implications, and then you set them against each other to find VAT payable or refundable. So normally, we know output tax is levied. You get it from sales, from income. That is one. And two, there are some supplies which are called deemed supplies. There are some supplies which are called deemed supplies. According to Section 8 of Value-Added Tax Act. So these transactions, when these transactions take place, you have to account for output tax, even though no money came in, but merely that transaction taking place, you have to account for output tax. For example, ceasing to be a vendor when you deregister, when you are no longer required to register, you are treated as if you have disposed of the assets you are holding, and then you account for output tax based on that. On indemnity payments, most businesses would insure their goods against theft, against damages, against destruction, against disasters. Yes, if the insurance company pay them out if a disaster occurred, then there is output tax implications if the insurance company has paid them in cash. But in terms of goods replacement, some insurance company would look at what is cheaper and easier for them. If it is easier for them, they would simply decide to replace what was destroyed themselves. In such a case, there will be no value-added tax implications. Supplies to independent branches and fringe benefits. Fringe benefits are those non-cash benefits which are given to employees by the vendor or by their employers. So if the employer simply give out an asset to an employee, it's a fringe benefit. The employee hasn't paid, but the employer is treated as if they've sold such goods they would have given to their employees. So there is output tax implications. There are many fringe benefits like the use of a company car, buying assets at a price which is lower than the market value, and then sometimes being given assets by the employer. Those would result into output tax implications. There are many. So, and as well, payments exceeding consideration. That is, if no refund was done within 4 months. These transactions have got output tax implications. And as well, you would see there are some adjustments, like the change in use. If there is a decrease in taxable use, then you have got output tax implications as well. So when you are looking at this question, keep an eye and check if anything like that is there, because when we are determining output tax, we are not restricted to sales only, but other transactions like deemed supplies as well as adjustments. So what I am seeing when I'm reading here, because we have, I would like us to determine output tax first and then input tax. What I've spotted here, which we have got output tax implications, it's indemnity payment, because we are not seeing any sales here. There's an indemnity payment of an amount of 128,000 rand. This one has got an output tax implications. So therefore, let's calculate the VAT portion on this amount. Hence, we are told that all amounts are inclusive of VAT. Let's be sure of the fraction which we use. If all amounts have got include VAT, you apply 15 over 115. As you multiply it by the value of supply. So that's what I've done here on this question, and therefore the output VAT that is going to be payable to SARS on this transaction, on this indemnity payment of 128,000 rand, is 16,697 rand. Any other transaction that has got output tax implications here, but we need to disclose, because I am seeing that the insurance case, you don't just leave it because you end up losing some marks because it's a transaction that took place. But as from my explanation here, we learned that if the insurance company replaces the goods, there's no value-added tax implications. So here, there's no output tax implications, therefore it's a 0. So yes, at the end, our total output tax would be 16,000 rand. Let me write total output tax. It's 16,000 rand. 16,000 rand, 697 rand. That is the total output tax based on transaction 1. There's no any other, no sales. This is the only. So therefore, let's look at all the other transactions and see which transactions have got input tax. Remember, input tax is the VAT that you claim from SARS. What happens, why claiming? Because if you buy goods and services from other suppliers who are registered as vendors, and then they charge you VAT, then you can go and claim it from SARS as input tax. So let's look for those transactions with input tax implications. So normally you claim input tax from expenses as well as some deemed transactions and some adjustments. So let's look at such. The first expense which I am seeing, which was entered into by Glamour Private Limited, it's insurance premium paid. The insurance premium paid of 1,100 rand. It was paid. It's an expense. It was paid in January and February, which is our VAT period. Then yes, here is the transaction. We multiply by 15 over 115 because that is the VAT fraction we are going to use to get 143 rand. Let's look again on which other transaction has got input tax implications. Well, we look at Litaniel, who decided to sell his personal computer to the company. on 25 February 2026, which is within the VAT period, for use in the business. The selling price was 8,000 Rand, which was the market value. So yes, it's an expense by Glamour. Here they bought a personal computer from Lithuania. So yes, Lithuania originally purchased the computer for 10,500 Rand. He used the computer 80% for business purposes as from 25 February 2026. The company also purchased an antique mirror for business use from the mother. Yes, this is another transaction, but let's look at the computer that was purchased by Glamour from the owner. Yes, it's an expense. Remember, I said if you are registered as a vendor, you purchase goods and services from other vendors. You would be entitled to claim input tax that you were charged. How about here? Is Lithuania as a person registered? The question is no, he is not registered. But the Value Added Tax Act requires vendors to claim what is called deemed input tax. They are required to claim what is called deemed input tax. They are allowed to claim what is called deemed input tax. The deemed input tax is claimed. The deemed input tax, here I'm looking at the section. Deemed input tax is claimed when a registered vendor acquires second-hand goods. If they acquire second-hand goods, even from a non-vendor, yes, the vendor is not going to charge you VAT, but it's a known fact that if you buy a non-vendor, when he or she originally bought that asset, because that non-vendor is not registered, they were not able to claim input tax. As a result, when they sell that asset, they did not claim input tax. They would try by all means to transfer that VAT to the next buyer. So if that next buyer is a vendor, SARS gave them the right to claim that hiding VAT that was transferred by a non-vendor. So that is it. As a result, we must claim what is called the notional input tax or deemed input tax. The value of supply is the lower between selling price and the market value. Based on this transaction, it looks like the market value was equal to the selling price. So this is the value that we use. Remember, when you claim input tax, you claim to the extent that asset is going to be used for making taxable supplies. So we are told that it's going to be used 80% in the making of taxable supplies, 80% in the making of taxable supplies. So 20% is more like exempt use. You don't claim on that portion, and as it is not going to be used for taxable supplies. So yes, you only claim VAT on taxable use, meaning 20% is exempt. So yes, you multiply by 80%, and that is the input tax we are going to claim of 835 Rand. And again, the last one on the antique, it's the same situation because Nathaniel's mother is not a vendor. Nathaniel's mother is not a vendor. Since the Nathaniel's mother is not a vendor, and the Antique Mirror is a second hand, then Glamour is entitled to claim the input tax, which is called notional input tax. The Antique Mirror is going to be used 100% for work purposes. So yes, so 652 Rand is going to be claimed. Okay, the total input tax, you add these three, and then you get the input tax of 1,630 Rand. So remember, I told you that VAT payable is simply output tax minus input tax. So here we go. Our output tax is more than our input. So the VAT payable, which in Nathaniel's business, Glamour is going to pay to SARS, based on transaction 1, is 15,067 Rand. So here we go. Let's take a break, and then when we come back, we'll look at transaction 2.